In today's video, I'll be revealing why a specific type of retiree is actually 5 times richer than they think, even though their account balance might not look impressive. If you're new to the channel, hi, I'm Julia, certified financial planner and managing director of URS Advisory. And through working with countless clients who fit this profile, I've discovered that they possess hidden retirement wealth that far exceeds what their savings numbers suggest. And that's exactly why I'm making this video today, to show you the investment strategy that could provide true retirement security. So let's get into it. Most retirees are familiar with the standard playbook. As you get older, you're supposed to steadily reduce your exposure to stocks and increase your allocation to bonds or cash equivalents. The idea behind this outdated theory is that because you're older, you don't have time to grow your investments back if there's a market crash, so you need a higher allocation to fixed investments. But there's a growing body of research spearheaded by Michael Kitces and Wade Pfau, two highly regarded retirement planning experts, that flips this traditional wisdom upside down, a theory called the reverse equity glide path. Instead of dialing back risk every year, this strategy starts retirement with a heavier fixed allocation to shield your portfolio from the devastating impact of an early market crash. Then, as time goes on, and the risk of sequence of returns damage lessens, equity or stock exposure is gradually increased. This retiree can end up 5 times richer than traditional glide paths suggest because they're able to capture long-term market growth in later retirement years. So in order to explain the why behind this, we first need to define why lowering your stock exposure upon retirement is important in the first place. And the reason is the sequence of returns risk. Let's learn what it is using an example. Here are Susan and Bob's portfolios. Susan's on the right and Bob is on the left. Let's start by looking at the left side of the chart under accumulation. Susan and Bob are both 45 and have $500,000 in their retirement plans invested in the S&P 500. As you can see, Susan's first-year return is positive 33%, and her 20th year return is negative 28%, whereas Bob's first-year return is negative 28%, and his 20th year return is 33%. So what you'll start to notice here is that they have the exact same returns, but in exact reverse order. Now, when they're accumulating the money, saving, not retired yet, does it matter what order the returns are in? No, they end up with the exact same amount of money after 20 years, right? Well, now we're going to look to see what happens once they do retire and have to start withdrawing funds. So let's look at the right side of the page. In this scenario, Susan and Bob just retired and have $500,000 in each of their retirement plans. They both will need to withdraw $25,000 per year to maintain their lifestyle, and will need that amount to increase at 3% each year for inflation. They have the same reverse order of returns as before, but now what happens? You can see that poor Bob runs out of money at age 83, whereas Susan's balance at 83 is just above $2.2 million. And this here illustrates the sequence of returns risk. If you are unlucky enough to retire within 5 years of a market crash, your chances of running out of money are exponentially higher. Even though they have the same returns or the same average, the order of returns, or losing a significant amount of money immediately upon retirement, is catastrophic to a retirement plan. And this is why bucketing your portfolio upon retirement is so very important. And in our practice, we only bucket or keep a heavier fixed allocation for the first 5 to 7 years. As they spend down their cash equivalents, their allocations naturally get more aggressive as they move through retirement. Okay, now that you understand sequence risk protection, if you need help optimizing your retirement plan, click the link below where I created a detailed training video that shows you exactly how to maximize your retirement plan as a whole, no matter what your current situation looks like. All right, now back to the reverse equity glide path, aka adding stock exposure as you age. This may appear counterintuitive at first because you may believe that your stock exposure should decrease throughout retirement as the time horizon and life expectancy shrinks. However, the reverse equity glide path makes perfect sense when you look at it from the perspective of what scenarios cause a client's retirement plan to fail in the first place, which is an extended period of poor returns in the first half of retirement. If your stock exposure declines after an extended period of low returns, that means you'll have the least in stocks if and when the good returns finally show up again in the second half of retirement. This, of course, assumes that the entire retirement will be dominated by poor returns. But if we look at history, this seems very likely, as we've never had an extended period, 15, 20 years or more, of poor market returns. So if you're following along and starting to understand why it's important to increase your stock allocation each year of retirement, we need to examine why this isn't mainstream advice. Why does conventional wisdom have us decreasing our stock exposure as we age? Well, first of all, there are psychological factors like loss aversion, which is that the older we get, we tend to get more nervous about having enough or running out. So basically, the fear of losses in later years feels more painful than potential gains. And this letting emotions run the show can mess up other parts of our lives too, right? We may be in a toxic relationship, but feel better when we're around that person, even though it's not what's best for us. This psychology shows up in humans all the time. It's also why it feels like you need to sell out of market positions when the market is down, because the fear of losing more outweighs the potential historical gains you will experience by holding. There's also the status quo bias where we as humans prefer to stick with established norms so that we don't have to get our mind thinking about new or better ways to operate. There's also institutional inertia through target date funds using declining glide paths, less and less stock as you approach retirement. And while we definitely want to reduce risk upon retirement, we don't need to be reducing risk every single year that we work. The irony is that the very intuition that makes declining glide paths feel safe is exactly what makes them suboptimal for retirement income sustainability. And I'm now going to show you the evidence. Remember, math does not lie. This chart, based on the groundbreaking research of Michael Kitces and Wade Pfau, shows the success rates over a 30-year retirement withdrawing 4% per year using different glide path strategies. The historical average capital market expectations are as follows: 6.5% for stocks and 2.4% for bonds, inflation adjusted. In the chart, the starting stock exposure is on the vertical axis and the ending allocation is on the horizontal axis, or where it ends up at the end of retirement. So a portfolio that starts at 60% stock and ends at 60% stock has a 93.2% probability of success. However, a portfolio that starts at 30% stock and finishes at 70% stock actually has the highest probability of success at 95.1%, not to mention a lower overall stock exposure, throughout retirement, 50% instead of 60%. The fact that the 30 to 70 stock allocation is more successful at a lower average stock exposure rate just goes to show you the value of bucketing your money upon retirement. It's the timing of your stock exposure that matters. And if you're withdrawing more than 4%, which we recommend frequently, your percentage chances of success will clearly be lower, making the timing of your allocation that much more important. This chart here displays the magnitude of potential failures by showing us how many years a portfolio will last at the 5th percentile, which is the worst 5% of historical stock market sequences. So this answers the question: if I am unlucky enough to retire into a really bad sequence of returns, how bad does it get? And we can see here that the 30% to 70% stock glide path lasts for 30 years, whereas the constant 60% equity exposure is depleted in 27.7 years, or obviously faster, in the 5% worst case scenarios. It's interesting that the 30 to 70% glide path is optimal for average and suboptimal returns. Admittedly, in our practice, we typically start our clients with a 50 to 60% stock allocation, right? Not all the way down to 30% in most cases. But we've also not been through a major bear market, and we also managed to cover those first 5 years of withdrawals, with that allocation, just depending on how much you have and how much you're spending. The reality is that if the first half of retirement is good, which is the first 15 years, the retiree is so far ahead that a subsequent bear market can't cause them to run out of money. But if the first half of retirement is bad, say if you retired in the late 1920s, late 1960s, or early 2000s, there is the risk that your portfolio would be depleted too severely by withdrawals during those bad years, that there wouldn't be enough money left to invest when the market finally does get good and you run out of money in your 80s. Looking at it another way, selling stocks as the market is declining or flat is liquidating while the market is down and not being able to participate in the recovery of the next big bull market when it arrives. So let's look at a case study to illustrate why this strategy can leave you 5 times richer than the traditional retiree. In the year 2000, 2 retirees, Margaret and Robert, each started retirement with $1 million. Both planned to withdraw $40,000 per year, or 4% of their savings, adjusting for 3% inflation as they went. On the surface, their situations look the same, but one key difference in how they invested would lead to very different retirements. Margaret followed the traditional advice. She began with 80% of her portfolio in stocks, planning to reduce that to 20% over the next 30 years. Robert did the opposite. Aware of the risks of market downturns in early retirement, he chose a rising equity glide path. He started cautiously with only 20% in stocks and planned to increase that to 80% over time. The first decade was brutal, right? The dot-com crash and the 2008 financial crisis hit hard. Margaret, with most of her money in stocks, saw her portfolio crushed. To cover her withdrawals, she had to sell shares at a loss, permanently damaging her chances of recovery. Robert, with most of his money in fixed investments, was shielded from the worst of it. He funded his withdrawals from the fixed bucket and gradually increased his stock holdings while prices were low. By 2010, Margaret's nest egg was badly wounded, while Robert's was well positioned for the recovery. Over the next 2 decades, the stock market roared back. Margaret's portfolio did improve somewhat, but the early losses had already done irreversible damage. By 2027, or 27 years into retirement, her savings were gone. Robert's story was very different. By steadily adding to stocks when they were cheap, his portfolio grew dramatically during the recovery. By the end of his 30-year retirement, Robert had more than $2.1 million, over double what he had started with. This chart illustrates their portfolio balances by year and stock allocation. 25 years into retirement, right in 2025, Robert has over 5 times what Margaret does just by following the reverse equity glide path. This shows the power of a small shift in strategy and how increasing stock exposure as you age can make you at least 5 times richer than your peers who follow the traditional declining equity path. So how can you make sure you end up 5 times richer? First, figure out how much money you need each year to live comfortably, and make sure that 5 to 7 years of withdrawals are covered in fixed investments. Spend down this cash over the years to gradually increase your stock position. This protects you from losing big money early in retirement when you're most vulnerable, while positioning you to benefit from market growth later when you have more in stocks. The key is to stick to a schedule rather than trying to guess what the market will do next. If markets crash early in your retirement and you have a healthy allocation to fixed investments, you can then ride out the storm and even buy more stocks at cheap prices as your allocation increases. When markets recover later, you will have more stocks to benefit from the gains. Don't try to time the market perfectly. Just follow your plan to increase stock exposure gradually each year. And get professional help if managing this feels too complicated. Be ready to make small adjustments if your spending needs changing or markets do something unusual. The goal is not to get lucky with perfect timing, but to build a system that protects you when you need protection and grows your wealth when growth is possible. This systematic approach is what turns a good strategy into a life-changing strategy with real wealth, like we saw with Robert ending up with over $2 million, while Margaret went broke, even though they started with the same amount of money. If you'd like help calculating your complete retirement wealth and building your dream retirement plan, click the link below because I put together a comprehensive training video that walks you through this process step by step, and I'll see you next time.